So we're going to be carrying on in our discussion about the balance of payments, the structure, how it works, the impact on the economy. It is a macroeconomic objective, as we said, which means that the governments can, in theory, be elected or unelected based on how they perform with regards to the balance of payments. Right? Has the deficit increased? Has the deficit shrunk? Now, economists are going to be quite clear as to the fact that the deficit really doesn't matter. Right? It's not that big a deal. But politicians might not see it that way, or people voting for politicians might not see it that way, particularly with, if you remember, some of the language that has been used about deficits by some of the previous American presidents in this particular context. KE5C7 is the Nearpod code. Now, one of the important things is to use the appropriate language, okay, the terminologies, and I mentioned about surpluses and deficits and what they are. And the trap that young students, young players, fall into is to talk about debt. And you'll see it also in the news media. They'll talk about a debt, a trade debt. Right? Now, yes, countries do have debts, absolutely. But that's not the same as a trade deficit. Okay? A trade deficit can create debt in a country, but a trade deficit, strictly speaking, is just as said, where your outflows are bigger than your inflows. Okay? Right. So, therefore, what I would like you to do is to explain the difference between a surplus on the current account and a deficit. Ready and go. What is the difference between a current account deficit and a current account surplus? Basically wanting you to define both terms. Yes, Joel, that's absolutely right. Okay. Very good, Fatima. Good work, Joel. Other Joel. Yeah, that's absolutely right, Han. Yes. Work. Okay, Ariane. Yeah, that's true. Looks a little Dr. Googly, that one. Oh, this one as well. Yes, Seon. Yes, you are right. That's what will happen. Right? So that's an effect of the current account surplus or the current account deficit. The question that you were asked was to explain, basically define what a current account deficit is and what a current account surplus is. Yes, that's good. Okay. Youngson, good use of capitalisation there. I don't know, Kendrick and Sariha, if you're able to have a go, would be good. We've lost Sariha from the meet entirely. Kendrick, let's see. Yep, that's good, Kendrick. Well done, team. Now, if we are to dive even deeper into the structure, okay? Now, again, there's a lot of terminologies that we use. So becoming familiar with them, able then to see them in a news article and understand what they're referring to, able to see them in a case study and understand what they're referring to is a very useful thing. When we talk about the financial account, so you remember you had the current account, the capital account, the financial account. So the majority of the weighing up of this balance, okay, is going to be between the current account and the financial account. So the financial account is going to be, if you like, the payment for the current account. So if you have the negative side on the current account, you need to have the positive side on the financial account. If, however, you've got a positive side on the current account, then the financial account, because it's on the other side and it has to balance, the financial account actually has to be negative. Right? So what is inside that financial account? All financial flows that involves ownership of assets. Okay? Now we can talk about what's called a productive asset, so capital goods, right, for example. And we can talk about non-productive assets as well. Those would be assets that really don't lead to any particular production, right? They are just considered in an accounting format an asset, right? So they're not capital goods, right? And we're going to consider that, okay? So here, for example, you've got what's called direct investment. So that direct investment considers the productive class of assets. And it looks at factories, so the building of the capital machinery with regards to factories, and what's called mergers and acquisitions, so when businesses join together. There was one announced just the other day. There's a New Zealand pet food manufacturer, and it has just been bought by a Chinese pet food company for apparently 1 billion New Zealand dollars. Right? This pet food company manufactures what is called luxury pet food. Wasn't there when I was there, so don't really know it particularly well.
David,
Hello?
just to check, so if the current account and the financial account, one has to be positive and one has to be negative.
Yes.
Okay.
All right,
Thank you.
because the overall structure, remember that tree idea, the overall balance of payments equals zero, and it has to. All right, and if we've made mistakes in our calculating somewhere, if there are things that are missing, so omissions, if there are errors, so we've made a mistake in the calculator, all right, then we have that additional line that we add, which is called net errors and omissions, which is exactly the number that we can't find. So therefore, the balance of payment structure, will actually balance, it will actually equal zero, right? Because we're going to add that net errors and omissions in. Okay, so even if there are things that get missed. But yes, you're absolutely right. Good point to clarify. Again, if the current account is negative, the financial account has to be positive. I tend to always pause because in my head I remember back to when I was at school and there wasn't such a thing as the financial account, right? When the current account is positive, the financial account has to be negative. When the current account is negative, the financial account has to be positive. in order to make the whole structure equal zero. Right, so we had direct investment, the factories, the capital goods. We also have the financial investments. That's where you're buying stocks, bonds, right, the shares, okay, the share market. They are considered a financial asset, but they're considered a non-productive financial asset. See, I told you I'd bring you back to that. So because they're not capital goods, right, they are just providing the money for businesses to, in theory, buy more capital goods. Right? What you're going to find is that there's going to be some big movements in the stock markets around the world at the moment, those of you who are keeping track. The Chinese property investment company is going bust, and it's like $300 billion worth of investment, something along those sort of lines. And it involves multiple businesses in China that all relate to that company. So the Chinese government's going to try and hold all that together. But the Chinese stock market is doing this. And because the Chinese stock market is doing that, then the Malaysian stock market is doing that, and other countries' stock markets are doing that, including the US. But you're going to find over the next probably week, a number of those big companies, their share prices are going to start rising again. And what's going to happen, I would guess, is that these companies will end up buying their own stock, which then pushes up their price. Right? And they're legally allowed to do that. It's a share buyback. Right? They're legally allowed to do that. But it is a little bit misleading when you see the stock market, the share price is going up, and the only reason that the share price is going up is because these businesses are buying their own stock. Currency trading. Now, it might surprise you, or it might not, that there are people whose job it is to exchange, to trade currencies of different countries. That's what they do. Right? Quite a stressful job, as you can imagine, because they're dealing with millions and millions of dollars, and they're moving it all around the world, trying to take advantage of different exchange rates and different interest rates in the different countries. And that will include what's called a speculative trade. If you haven't seen the word speculative before, you'll be much more familiar perhaps with the word gambling. If you are speculating on something, you are guessing. Right? You are predicting. You are gambling. And the stock market is a gamble, yes, and currency trading is a gamble, absolutely. But there are normal, everyday people who do that because they need to trade with different countries and they need to move the currencies around the world to do so. Right? But then there are people who say, I'm going to invest in the Malaysian ringgit because there's a certain exchange rate that I want to take advantage of. Right? And then there are the people who say, well, I think in the future the exchange rate is going to drop, so I'm going to do this. Or I think in the future the exchange rate is going to go up, so I'm going to do. Right? That's speculating, that's gambling, that's guessing. Right? And there's some quite fascinating examples of how all of that works. And we're going to talk a little bit more about that when we deal with the exchange rate topic, which comes in a bit. Right, so thinking here also that we add the current and the financial account, and that gives us the basic balance of payment structure. Because that capital account was as small as it was, it's not really going to make a huge difference to the balance of payment structure. So when we think about the financial account and when we think about the current account, they're the two big parts of it. So, what's actually in the capital account? Right? Very small account. But as you see, it's got some quite quirky things inside it. So, patents and copyrights, the sale of those. So, if you've ever, I don't know, if you would have ever done, you probably, I don't know, any of you patented anything? Don't know. All right. Trademarks a certain thing. That's possible. Copyrighted a song that you wrote. It might be what's called a franchise, and because they can move around the world. You can transfer a franchise into a different country. Leases and other transferable contracts. There's also something that's very much in the accounting end of the spectrum, and it's called goodwill, not to be confused with the American company which I believe is actually called goodwill, but in any case. It's an accounting measure that deals with basically the reputation of a business, okay? And they put an actual number amount on it. And so when a business gets taken over, when the accountants calculate all of the different revenues, etc., and work out how much they're going to pay for that business that they're taking over, right? They will add as basically a separate heading, they're paying this amount specifically for goodwill, which is the reputation of the company. And it's quite a, I was going to say ethereal, a vague concept, right? There's nothing particularly hard hitting with it. You can't really concretely define it other than to say goodwill or reputation. The transfer and ownership of any fixed assets, so the actual the building itself, right, for example. So if the ownership of the building is now belonging to a company from Micronesia, right, then the money goes overseas, for example. You're going to see more of that contribute to the idea of patents and copyrights, that contribution. So if you've been involved with any of the choirs or any school production, like drama, musicals, you'll probably note that the songs and the plays, etc., have copyright restrictions on them, and technically schools are supposed to pay for those, and if they don't, they get into trouble. So it's that sort of payment. And it's also why there's legal battles between companies about who's, using the trademark of this image and so on and so forth. And there are a lot of those that happen as well. So any of that sort of information goes into the capital account, but as I said, it's really tiny in comparison to the rest of the account, the rest of the balance. So what I'm asking you now is, what is it that was in the capital account? In your words, explain what the capital account is all about. There we go. What was the capital account all about? Some answers coming in. Oh, that's an interesting way to describe it. Yes, monetary value, but not actually money. Okay. I guess you're actually right on that. It's a financial value. Good. Fatima. Good. That's Kendrick. That's more of an accounting definition as opposed to a national income account. So you need to think about the national income accounting with regards to the capital account. Good. Yeah, I don't know. You've written, Joel, anything transferable. Assets, maybe. All right. Wait a couple more seconds for the rest of you. Sorry, there we go. So when you are considering how they calculate all of these things, there are quite a lot of, there's huge amounts of data, right, from around the world, and they're going to make mistakes. Okay, even with an account like the capital account, which is arguably quite small, trying to work out the trademarks and the copyright payments and all of those other sorts of fixed asset transactions, they should be possible to track, but tracking all of those copyright ones, that's really hard. It's one of the big disagreements between countries like China and America, for example, the idea of trademark or copyright infringement. They're not paying for it. Here's an example, right? Case study wise, this is the UK, I mean, it's not recent, current account. So as we look at the data, right, so it's only 2003 to 2005, and what we see here is the balance on trade. Negative, 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 negative. Right. Overall average is negative. The services seem to be positive. Net investment, yeah. So therefore the overall current account as a percentage of GDP, we see it as negative all the way through, and here on average is negative as well. So how might you see it in an exam, in a table like this? Right, what's happening here? This is goods, this is the balance on goods. So it's the export of goods minus the import of goods. So this is telling us that the UK is importing many more millions of goods than it is exporting. On the contrary of services, on the service side, the UK is actually exporting more services than they're importing. And as I said to you before, the UK for a long time was more or less one of the financial hubs of all of Europe. So banking, insurance, all of those sorts of businesses would be the contribution there. You could be asked to work out averages. Yes, it's possible for you to try and work out percentage changes over the time. Right, that's possible to work out. This one here is the percentage of GDP, which was one of those comments that we made earlier as to how you might see this represented. So negative 2.4 to negative 2.8. There were periods in time in the early 2000s when it was actually less than 2%, which is these two time periods here. Okay. You could make some comment about what was possibly happening in 2002 and 2003. There might be additional data, right, additional information in the case study that says something happened in 2002, 2003. Yeah, right, that caused that. That's then the application, right, side of this. So that's an example of how this information might actually be used. How important is this particular idea? Very. Right? There are a number of countries, and the UK is one of them, but there are a number of countries whose GDP, a large part of their GDP, is actually taken up by international trade. Right? New Zealand, for example, is a very heavily export-driven economy. If New Zealand has issues with its trade, then our GDP shrinks, right, considerably. So New Zealand needs to be very, very careful of that. So if we have a look here, this is the UK. Exports boost the UK GDP. UK exports are 28% of GDP. So not quite a third, right, which is a significant amount of money being earned just from exports. So when you see that, it's all, a little bit under $1 in every $3 in that economy. That's pretty impressive. At that time, it may have changed obviously over time. Now you'll look and notice this next point here highlighted. The UK is the world's second largest exporter of services behind the US. And as I said, things like banking and insurance. That has declined a bit on the basis of the Brexit that's happening at the moment. But generally speaking, they are still very big in the service industry. Right. And then what do we see as a result of this? Well, the flow-on effects to the economy, employment, right? Those macroeconomic effects, employment and incomes. We're talking here about the supply chain, right, further down track, right, which is something that they're having issues with at the moment. I don't know if you've caught up with the news that there is issues with the supply chain in the UK. The pandemic hasn't helped, but also the Brexit has definitely not helped, and they are worried that there may be some supermarkets that run out of products because they just can't get them into the country. Regional economies and the exports from those regions. Some regions within the UK are much more dependent on exports than others, and again you're going to find that in different countries as well. Right? Even here in Malaysia, there might be, say, the centre, say KL, right? Much more business-based, much more service-based, and then you go to some of the islands, and maybe their economies are more based around export, possibly. Why do you think trade and exports could be important to an economy? So thinking of all those macroeconomic effects. Ready? Go! So looking at the macroeconomic effects of international trade, but particularly trade and exports. What does it do for your economy? Case study that we looked at before was the UK. You don't have to use the UK particularly. It could be a different country. Have a go. This is coming in. Yeah, okay. Yep. Yes, that's true. Still trying to add in those macroeconomic effects, though. Yes, good, Arena. And then what? Right, so they earn extra profits. Oh, what happens then? Yes, good, Joel, well done. Now, because it's macroeconomics, you can basically keep going forever. Right? because each effect will have a flow-on effect to a different group in society, which has a flow-on effect. The multiplier effect for those of you who are HL learners, and will remember that. Yes, good. What else? Good, absolutely right. Yes. Well done, Fatima. Good work, Dawan. Absolutely will. Good work, Han. You also included the case study. Excellent. Good. Waiting on a couple more. There we go. What I used to do in my notes is have like perhaps a little code, or even just, words down the side of the page. That would be the triggers that I needed to make sure I'd checked I'd included all of that in my answer. So if you were talking about the macro economy, yes, you talk about aggregate demand. I can't see where I'm writing. Yes, you talk about aggregate demand. Right, so I'd have a little page. I'd be writing in here, and then I'd want to make sure I talked about employment, income, tax revenue, standard of living, right, and basically planning what I'm going to be writing in there, yeah, and it was a quick way to do it, and then I can just go like that, done, yeah. If it's a however, you could talk about inflation, right, okay, export dependence on different regions. Or you could conversely have a scrap piece of paper next to you, and you just make those notes on a scrap piece of paper. Right. As you sit in the exam, just quickly sketch out what you think you'll answer and how you think you'll answer it. And then, away you go. And then as you write, you just check, have I included this, have I included this, have I included this? You go back to the question. Have I answered this in the question? Have I answered this in my answer? So this is explain why trade and exports is important to an economy. So somewhere within there you would be explaining all of that, and then you'd look up to go, aha, that's what I would do, and of course you would be remembering your real life examples. Right? And you would have those pre-prepared, right? Just pull them out, put them on the page. So it might be the UK economy, it might be the Malaysian economy, it might be who knows who. Yeah? You could do a comparison, UK economy versus the Malaysian economy. Right? Again, it just depends on your particular real life examples that you have come up with. Right. The sorts of things that we find in the trade in goods. Well, quite clearly, the terminology is going to be important again, and this is because you will see it in the news, in the news articles, in the textbooks, etc. Phrases that will be used are things like consumer durables. If something is durable, it is longer lasting. So Duracell batteries, longer lasting batteries. So household goods, motor vehicles, personal computers, we expect those to be slightly longer lasting. Excuse me. All right. Capital goods, so those machines, technology, software, basic commodities, so those sort of raw materials right, that get used. Okay, the oil and other fuels, the minerals. Right, there's a big trade in minerals around the world. Components and basic raw materials, foodstuffs and beverages. Again, same idea. You see that happen quite a bit. You can go to the grocery store and find Korean products in the grocery store, Japanese products in the grocery store, Chinese products in the grocery store. They're importing products from all around the world, foodstuffs and beverages. In New Zealand we used to have a section of our supermarket, and it sounds, I guess it's how supermarkets do it, it's possibly the easiest way, right? But you had what we called the overseas sector, the overseas section, right, in the supermarket. Where do all these products go? They all go in the overseas section, which were any products from different countries, right? So you just put them in there. And customers knew to go to that section in order to find them. Which is, when you think about it, that is a bit odd. So you'd have all of the different products, whatever they all were, put in this area just because they were from a different country. As opposed to like putting all of the pot noodles in the one place. There is an example, again, likely to find this sort of image in a news article, possibly illustrating the balance of trade in goods, and this is from the UK's point of view again. It's the same data, more or less, that we saw before, but we were looking at this time period here. But it's actually gone all the way back to 1985, those of you who remember back that far. Right? And you'll actually see that all the way back in 1985, they didn't have a very big deficit in the balance of trade and goods at all. Right, you'll notice in here, right, there's actually a decrease in the 90s in their deficit, and then from the late 90s on into the 2000s, that deficit just gets bigger and bigger and bigger. And again, it might be that there's aspects of the case study written that you're then able to say, in this time period, this was happening. Now, this is the UK, so a lot of this has to do with Europe. All right, so a lot of this idea here is about the European Union, right, and the membership in the European Union and all that came out from there, right, 1999, right, the European Union, and the lead up to it, right. So you could make a comment about the size difference. Okay, that the more the UK joined Europe, the bigger this trade and goods deficit has grown. Yeah, you can make that as an argument. You do need to consider the size of the economy, and that the size of the economy will have also grown over that period of time. So you could make that as an argument too. All right. There it is, expressed as a line chart. Same time period, but instead of it being bars, you've got the line. Right, so by way of showing you what the data could look like in your paper too. Right? And here again, the same sort of questions could be asked. What's happening here? What's happening here? Look at the time period. Right? What the difference between this period of time and this period of time here. Right? And discuss. Being able to identify specific time periods and say, because that's about billions there, billions of pounds, and say, talk about what the actual number is, talk about the change from here to here, what the change is, right? Maybe do a percentage change as well, that's entirely possible. Now that's quite an interesting one because this is the trade in oil. Right? And what you may see here, I'm hoping you do, is that the trade in oil was quite positive for the UK in the 80s. Then as you move through here into the late 90s, early 2000s, it became quite negative, trade in oil, which tells us that there's a big disparity or a big difference in the production, right? That the UK was at one point exporting a whole bunch of oil, later on importing a whole bunch of oil. More being imported, more being exported. All right, and again, you make the comments what was happening. This is about joining the European Union. This is about increasing the market and selling more of your products internationally, but then importing more of it. All right. It's about the growth in your economy during that same time period, increase in population size, increase in production, needing more oil, all of those sorts of ideas. Right, very quickly, last thing for the day. The UK, believe it or not, was actually a net importer of oil until the mid-70s. Right, they found, and you don't normally think about the UK with regards to oil, but they had a big North Sea oil drill. Right, and they had very high surpluses, as we saw in the 1980s. However, the source of oil, so the production of the oil, started to decline. They joined the European Union. There was more access to oil from different parts of the world, and there was a sharp fall in that oil surplus since that sort of time, in the early 2000s. Right, to the extent that the UK now is very different, all right, with regards to oil production. All right, now